So thank you for the questions that we had on the Q&A video. It was really good to see what people are interested in. Some of the questions are a bit off in terms of what I would have expected, and some were spot on. And I had a look through that list of individual questions, and one of the questions that kept coming up repeatedly was about data collection, data mining and so on. So that's what I'm going to talk about in this video. If you're interested in learning to trade on Betfair, then visit the BetAngel Academy, where you have detailed, structured Betfair trading courses. Or why not visit our website, where you can download a free trial of BetAngel Professional, but also visit the forum, where you can get detailed images, examples and downloadable files. And don't forget to subscribe to our YouTube channel and click on the bell icon if you want notification of new videos as they're released. So yeah, by coincidence, I mean, we had this question on collecting data and stuff. Lots of people have picked up that I spend a lot of time looking at data, and it is part of what I do. It's an important part of it. You very often see people focused on execution and stuff, and that is important, but also understanding what you're doing and understanding the market, I think, is an equally important part of what you can do. So when we look at trading overall, I don't see it as being separate items. I see them all being rolled in to one big mix. So my normal process is I will have an active trading day. I will gather data on what I did during that day, and then the following morning I will analyze what happened. Now, I say the following morning, sometimes that just doesn't work out. So I may find myself on a Monday or a Tuesday looking at all of the data from the previous week. So it's a process of continuous improvement. The Japanese have a word for this. It's called Kaizen, and it's sort of to do with small incremental improvements over time. So if you think about it, it makes perfect sense, because you're probably unlikely to have an optimal strategy at any one point, but by tweaking and refining it and getting this positive feedback loop, you'll get better and better over time. So when you look at the level at which I trade now, I didn't sort of suddenly leap there. It was just very, very small, gradual incremental rises, and then, you know, each of those compounded on top of each other leaves you in a much, much better place. But it's important when you're looking at data to understand specifically what you're looking at. So at a core level, what I'm focusing on is strike rate, i.e. how often am I winning, and how much do I win when I win, and how much do I lose when I lose. But that's split across individual strategies and across individual sports. So as I've said 1,000 times before, I know that my strike rate on racing is about sort of 70 to 80%, and that will rise and fall depending upon the conditions within the markets. So, you know, if I turn up one day and suddenly my strike rate is 30%, I don't collapse into a mess on the floor and think that I've lost it. I'm just assuming that is, you know, just a bad day. And, you know, if I then look at the rolling total for a week, I can see what that's like, in the rolling total for a month, and I look at year-on-year data as well. So that tells me, am I improving, am I getting worse, or what's happening within that particular market. So yeah, you know, those are the three things that you must measure on a regular basis: is your strike rate, how much you win when you win, how much you lose when you lose, because that defines your trading expectancy. If you see one of those characteristics declining, then you can act to address that. But that's the core basic data that you definitely should be monitoring on a regular basis. I have data going back since the time I first traded on Betfair, so I can see how things have modified over many years. But let's look at specific sports. We have a great thread on the forum that is debating the benefits of backtesting, and one of the things that I said, which appeared to be controversial, was that I didn't rely upon backtesting to create strategies. And, you know, obviously I do look back at data and analyze data in significant depth, but for me, backtesting is trying to find a profitable strategy in a set of data. And I have warned on this before: when you analyze very large chunks of data, what tends to happen is you tend to find what you're looking for. And you may find little bumps and ripples within that data, but when you actually put that to practice in the market, you find that they all fall apart really quickly. So for me, the most important thing is to not scour tons of data to find strategies. It's to scour tons of data to find little bumps and ripples that I can then go on and attempt to explain, and then see if I can find a way to exploit that within the market. Let me give you an example. If we look at the market that's behind me on the screen, if you scroll right to the bottom of the ladder, what you will find at odds of 101 are significant sums of money. Now this is many hours before the race has actually started. And what's the point of that? There's no way that these people are going to get matched before the race goes in play. Well, that said, sometimes weird things do happen, but let's put that to one side. They're not going to get matched before the race goes in play. So why is that money sat there? Well, if you look at that money and then you watch, I suggest you do it this afternoon. Go and find a race, have a look at the ladder, scroll to the bottom, and you will see on the favourites, loads of money at 101. And then sit there and watch it as the race turns in play, and you will find that that money stays there. Why? Because if you back test data, you will find that laying at 101 is generally profitable. And that is because horses that are miles in the lead and about to finish the race sometimes do weird things. And over a very long period of time, that has generally been a profitable strategy. Well, that's what the back testing tells you. Now you try and do that in real life and you will find that it is unprofitable. So this is the danger of looking at data and back testing strategies, that when you actually take them and put them live in the market, you find that they do not work. And that is because data only contains sort of what happened, not how it happened or how to profit from it. It just is a measure. You know, very often you can find stuff that looks good when you're back testing it and trying to run strategies on historic data, but they just don't translate into reality. There are a number of reasons for that. On this particular strategy, you need to be right at the front of the queue. But of course, there's a race now to be right at the front of the queue. So as soon as the market's open, the odds at 101 get populated with a lot of money and people throw big amounts of money within there. When that first happened and when there was nobody there, you could probably do that quite easily. Just turn up, put some money in the market, and you'd probably make a little bit of money. But now there are loads of people. So not only is getting into the market first important, but also where you are within that queue of that 80,000 will determine whether the strategy is profitable or not. But also think about when the race is happening. Say there are 2 or 3 fallers, a horse gets a 20-length lead within the race, but then starts to weaken. Now, if you're watching the race, you can probably cancel out some of those positions if you think that there's a threat within the race, or you can leave the position in there if the horse is running well and looks like it's going to win and also doesn't have any fences to clear. You know, you can decide if that perhaps you want to cancel that position at 101. So despite the fact that it shows up within the data as a potentially profitable strategy, actually getting it to profitability within the market is very hard. There are several hurdles to overcome. So when I look at data, I'll try and look at it to shape what I expect to see. If you've ever used Tennis Trader on BetAngel, the idea behind that is it says to you, here are all of the scenarios that are in front of you and where potential profit is going to be within the market. But as a trader, you position yourself ahead of that particular move. So my preference when I'm looking at data is to model it. You use historic data to understand the structure of the market, the way the market works, and what happens at certain points within the market. And you know, if you turn up to a certain type of race this afternoon, and you look at that from a historical data perspective, you'll find it has different characteristics from another race. So what you then do is you can sit in that market and deploy a different strategy for the characteristics that you expect to see. Now, when you sit down and actively start trading it, then you'll begin to understand exactly if that characteristic is playing out or not. You will recognize the characteristics of that market, and then you can proceed with whatever strategy you're deciding to do. But ultimately, you know, that's where you have to cross this line behind looking at data, analyzing data, and then actually doing it. There's a gap between the two. If you just try and find a strategy in a generic set of data and then deploy it in the market, you'll find there's often a mismatch. So my recommendation to you, analyze data, look at it, but it's more about the implementation in the market that is the key. If you get that right, then you will, you know, you'll do absolutely fine. I've often found strategies through implementation in the market that do not appear in the data. They just are not there because you're doing certain things at certain times in a certain way that does not get reflected in the data. When you look at historic data, you don't get to see fill rate, you don't get to see, you know, how what you're looking at was related to something else that happened that day and all of those sort of things. So my preference always is to put money in the market. Even if it's just the minimum stake, you'll get a much better data off of that. So to give you an example, I run a bot that runs every day, whether I'm trading or not, and it basically puts 2 orders in the market and then sees how frequently they were matched. And also it measures everything to do with the amount of volume that's going through the market, how much money arrived and when, and how quickly those 2 orders matched, depending upon when it put those orders in the market. And that just gives me a feel for how the market behaved, and it's instantly replicable within my strategy because it's using real money in a live market. Now, the reason I can do that and not have to worry about it and not have sleepless nights or anything is because I know that the market itself, as I've mentioned before, is equally distributed. If I put random orders in the market, over time they're just going to net themselves out, and therefore I don't need to worry about it. So I analyse that data on a regular basis just to see what's happened. So I can tell you right from the very first market I traded on Betfair to now how the market's changed over a period of time. And that allows me to adjust strategies ahead of that activity within the market. So yeah, it's important, I think, or more important, to use real money in the market. You're not going to lose a great deal of money, but it will allow you to test and refine strategies. And the way that you do that is you choose one strategy at one extreme, then you put it in the other direction, and then you start refining it from there. And okay, it takes a bit of time, but you do get real live data off the back end of it. But you can find data and useful information in the weirdest of places. So I think I said in a previous video that I'd backdated all of my football data as far as I could and went back to something like 1873 or something. And lots of people said to me, why on earth would you do that? What's the point in doing that? Well, you never know what you're going to find within data, because when I took that data and plotted it by calendar month, I started to see unusual situations develop within that data. But I also saw that the unusual variations that I saw in that data changed over time as well. And the unusual thing about it was goal data that I was looking at on this particular occasion. The unusual thing about that is you could see that the number of goals scored in the leagues has been generally shrinking over a period of time, but I also noticed that they varied over the calendar month. So I dug around in that data, tried to understand what was going on within that data, and the contrast between a match that took place in the 1970s and one that took place in the year 2000 allowed me to sort of begin to understand the characteristics of the detail of exactly what was going on. So what I'd actually discovered in that data was the improving quality of pitches, basically. So if you look back, when I used to go to football as a teenager, the pitches used to be pretty awful in the winter, but obviously they're a lot better now. So there's a complex interplay there between the state of the pitch and the prevailing weather conditions and the number of goals scored. So I discovered that just by looking at historic data. How do you exploit that? Well, obviously you can't go back to the 1970s and place a bet, but what you can do is you can look at pitch conditions and related phenomenon now and anticipate that will influence the outcome of a particular match. Now, the problem with football is it's highly variable, so it's not a characteristic that shows itself immediately. It's only if you do it over 100 or 1,000 matches will you begin to tease out some of the value that you find by looking at data like that. So, I find all data useful. I would say that looking at historic data, I tend to use that to model a market, because if you use the data to understand how the market's likely to move, then you can anticipate that, and that's what you're essentially trying to do with trading. You're trying to anticipate that something is about to happen. You're not going to get it right all of the time, but you can anticipate that something is about to happen and exploit that. But if you try and rely upon historic data to come up with strategies, you'll probably fail, because actually the execution and the deployment of that strategy is a key part of the trading process. I also think that when you're data mining or back testing, you can suffer from statistical deja vu. You very often see the things that you want to, rather than the stuff that is there. But the best way to temper that is to actually put something into the market and start testing your assumptions as quickly as you can. So yeah, there's so much data, you can cut it as many ways as you want. The problem that you have is if you cut the data too fine, you end up with irrelevant stats. So, horses that begin with the letter J that are running at Kempton, who ran 5 days ago, win on average higher than something else. Is that something that you can model? Is there a reason for that to happen? Why should that happen? If you can't answer those questions, you probably haven't latched onto anything. But if you can come up, for example, in football, the example that I gave you, with a rationale as to why that could be the case, then you've probably got something valuable out of your data.